Kelly, given the dire trading across a number of industry sectors right now, presumably we're heading towards a sharp increase in the number of insolvencies.
Yes, James, sadly, I think you're right. There are a number of government initiatives in place at the moment providing a critical lifeline for businesses. However, they are only short term, and I think directors need to be looking very careful at the long-term viability of their business once these government measures stop.
So the Corporate Insolvency and Governance Act kicked in June, which froze winding up petitions. So when will this increase in activity kick in, do you think?
So currently, as you quite rightly point out, there are restrictions for creditors to issue winding up petitions and statutory demands. Those provisions were due to expire at the end of September. They were then extended to the end of December, and I wouldn't be at all surprised if they're extended again. They obviously cannot be extended indefinitely, and once those provisions are lifted, I think we're going to see a wave of creditor action and a rise in winding up petitions and obviously subsequent insolvencies.
So what do the statistics tell us?
So if you look at the number of insolvencies this year compared to last year, they are significantly down. However, this will undoubtedly be a result of the winding up restrictions that are in place, and in particular the compulsory liquidations are sharply down compared to last year, which means that we're only storing up a problem for the future.
The Act was designed to give firms breathing space, but what does it mean for directors?
It's difficult. Obviously, as a director, you've got a number of hats. Your primary duty is to do the best for the company and all of its stakeholders. As you touched on, employees, the suppliers, the clients, there's a number of hats you need to wear. But likewise, if you've got personal guarantees out to lenders, you are going to be mindful of your own situation. So my advice to them is to seek advice from a professional and see what options are available to you, because at the moment these government measures are sadly propping up a number of businesses in the short term who should be taking advice. The options available to people taking advice early will be greater than the options available, say, 6 months down the line when cash has run out.
The government plays so many measures to help struggling companies, but what's your view? How do you think we unwind from this situation?
Absolutely. I think it's scary to think about how the government is going to claw back all this liability. I think the idea that business will go back to normal and keep working and generate revenues, generate tax income for the Crown is all well and good, but there's such a devastating impact on a number of industries. I just feel that this is something that we as taxpayers will personally be feeling for many years to come, as well as businesses. I mean, tax rates, etc., corporation tax. There's going to be all sorts of initiatives to try and claw back some of this money.
As you say, Kelly, we must consider the role of the taxman in all of this. On the 1st of December, HMRC regains its preferred creditor status. What does that mean?
It's interesting, isn't it? So this was something that was introduced prior to the coronavirus pandemic. It was something that was drafted into the Finance Act last year, but it was due to come into force in April of this year. However, because of the pandemic, it was pushed back and is now due to come in place from the 1st of December. So this puts the Crown in a much better position in an insolvency situation than they currently are. So currently, the order of priority of distribution of assets would first go to the fixed charge holder, which is primarily a lender, a bank or an asset-based lender, from those fixed charge assets. Typical example would be book debts. Next in line would be the current preferential creditors, which are certain elements of an employee's claim if they've been made redundant. Then the rest of the funds would go to the floating charge holder, which again typically tends to be the banks who have a fixed and floating charge, and then the rest of monies left over get distributed to the unsecured creditors. So back 18 years ago, it was interesting because the Crown were a preferential creditor, but they were a preferential creditor for a specific amount of debt. So it was VAT for the past 6 months prior to insolvency, and PAYE and NIC for 12 months prior to insolvency. This new ruling is uncapped. So they can be second preferential, so they are ranking behind the employees, but it's unlimited. So it's any outstanding VAT and any outstanding PAYE and NIC.
So will the taxman push to wind up struggling companies if they see no other way of getting their hands on overdue payments?
Before the pandemic, we predicted that once the change of legislation came in April, that there would be a wave of winding up petitions issued by the Crown. They obviously chose for political reasons to delay that till September. However, right now there is a record number of businesses on time to pay arrangements. There's also been the deferral of VAT in March and June quarters as a result of the pandemic. So the Crown debt must be at an all-time high, and at some stage they have got to do the right thing and look to pursue payment of these liabilities.
So the big question is, should firms try to restructure before the 1st of December? And if they can't, what next?
Absolutely. If you're sat there as a director with debt that you're struggling to pay back both to your lender and to the creditors in general, including the taxman, you will be in a better position, or your lender will be in a better position, if you take action to instigate an insolvency process or a restructuring process prior to the 1st of December than you will be after that time, where the Crown will then be in a more higher order of priority than the lender will be currently.
What does that mean for directors, particularly of small firms who've extended some sort of personal guarantee?
Absolutely, there's going to be far more exposure to directors who have personal guarantees to lenders already. In terms of new finance coming out, the lenders will be looking for greater security than they have before. So they'll be looking for higher PGs. They may even look for fixed charges over specific assets. I had one quite recently where they were adamant they wanted a fixed charge over some fixed assets as well as a floating charge security. They obviously knew about this legislation coming into place.
So looking further out, Kelly, there are changes in the pipeline for pre-pack administrations that could come in as soon as next summer. What should people be looking out for?
So this is very much in consultation stage at the moment, and they haven't actually been crystallised into any kind of bill. But the proposals are that a company must not be transferred or sold to another party who is connected with the insolvent entity. So it's basically looking at the Phoenix companies. And that happens quite a lot with pre-packs at the moment, as people are well aware of. Currently, we can do that. We can pre-pack on day one. The new legislation is suggesting that a business cannot be disposed to a connected party for 8 weeks following the appointment unless that sale has been ratified by creditors or an opinion has been provided by an independent person called an evaluator. That this could have disastrous effects on the whole concept of saving a business as a going concern. The idea behind a pre-pack is that we can move swiftly in a crisis situation, rescuing jobs, securing future trade for suppliers. And without this ability to move quickly, I think we will see a reduction in the amount of businesses that are saved going forward.
It sounds like there's a trade-off here. It could be harder for firms to slough off their liabilities, but it might mean that fewer firms get saved.
The timescales with these things are imperative, and if the businesses can't be saved, there's obviously a knock-on effect on future supply for creditors, the employees, which obviously then impacts on the unemployment rates. And I feel that this would be a detrimental thing for the process, for the industry, and for businesses as a whole.
So wrap this up for me, Kelly. What should companies and their creditors be doing right now?
Now is the time to not bury your head in the sand. You need to take a very close look at your cash flow, make sure you have a plan in place, and make sure that you're looking at that regularly. You need to undertake an overhead review. Are there any costs that can be mitigated or reduced? You also need to look at other avenues of revenue. You may not be able to rely on your steady income that you had before and need to look for other areas where you can increase your income. Communication, I think, is also the biggest message to take away from this. There is nobody on this planet that hasn't been affected by the pandemic. People will understand. You need to talk to your shareholders, you need to talk to your lenders, you need to talk to your creditors, and you need to talk to people and explain the problems you're experiencing and keep that channel flowing. People will make greater allowances now than ever before. So as long as you are taking advice from advisors, speaking to people where you need to, you should hopefully come out the other side.
Thank you, Kelly.
Thank you.